Well, joining me now is Otto Dargan from the Home Loan Experts. Welcome to the show, Otto.
Thank you. Thanks for having me on.
Now, do you want to share very quickly with the viewers basically what you do? And you've got a very different back office to most other people in the world, haven't you?
Yes, we're a mortgage broking company based in Australia, and we're specialist mortgage brokers. So we handle stuff that's often a little bit trickier than other mortgage brokers. We've got a team of 20 brokers and a team in total of about 200 people, mostly based in Nepal, funnily enough.
Yeah, so certainly a different background. Now, I know you've helped me a lot over the last 6 months or so, and we'll talk about that later on. But in terms of general, we're obviously kind of 5 or 6 weeks into COVID. Are banks still lending at the moment?
Yes, they are. And it's a bit of a strange situation. We've seen some lenders pull back on policy and be a bit more conservative, but others actually haven't changed policy at all, which is something we didn't expect.
And so, what are the banks seeing as risky at the moment? Because, I mean, just like we've always said, or we said on the show before, that no one really knows what's going to happen. I assume the banks don't either.
No, they don't. This is a situation where I don't think anyone can really predict the future. But the one thing that they are very certain about is income. They know that if you lose your job, then you're not going to pay your loan, and they don't want to see people on repayment holidays. So for them, that's the big area of risk. In particular, they're looking at casual employees, they see as very high risk, contractors also as high risk, and some income types, so overtime, commission, bonuses, things like that. They don't want to rely on these income types. But interestingly, they still will accept them, just some lenders are using less of that income than they would before.
Now, we've had 2018, 2019 with APRA, the Royal Banking Commission, and that was an absolute nightmare for serviceability. Obviously, COVID's tough as well. So, did things kind of go really bad, then get better, and then get worse again? Or are we still better off than we were 2 years ago?
Yeah, pretty much. It's been a bit of a roller coaster ride for property investors in the last couple of years. But in terms of serviceability, interestingly, that's actually got a little bit better because of COVID. Because interest rates have dropped, some lenders are now allowing you to borrow a bit more than you could before.
Now, you mentioned before that they're worried about income. So, if you're an existing mortgage holder, they were saying that if you take that 6 month holiday, then it's not going to affect your credit history. Is that what's happening from your side as well?
Yes, it won't affect your credit history, but I think there's a bit more to it than that. Say you take a 6 month holiday and then you look to get a new loan immediately afterwards, they're probably going to want to see that you've made your payments on time for probably at least 6 months before they give you a new loan. So it doesn't affect your credit history, but it may affect your ability to borrow immediately afterwards.
Right. Okay. So let's talk about the property market now. We obviously can see what's happening on the ground, and obviously different areas, different things are happening. But what are you guys seeing, or what are the banks portraying is happening at the moment?
So what's happened so far is property prices haven't actually fallen yet. I think a lot of people were expecting to see property fall off a cliff, the way the share market has happened, but it just hasn't happened yet. And I think the reason behind that is because of the repayment holidays. With so many people just able to defer payments for 6 months, there hasn't been a large number of people that are in hardship that are forced to sell their properties. In terms of what the banks are thinking is going to happen, a lot of banks made predictions in March or February, and to be quite frank, that's out of date. It's been a rapidly evolving situation, and Australia has flattened the curve a lot better than other countries. So I see CBA's prediction as the most recent and so probably the most accurate, and they're predicting a 10% drop in prices. But again, on the ground, what we're seeing is that there's still a lot of buyers. So I don't think that we're going to see property price falls in the next couple of months.
And I guess when it comes to valuations, because the danger is, say, if you buy a property today, and we were thinking this 5 weeks ago, right in the middle of COVID, if suddenly then the bank doesn't do a valuation for maybe 4 or 5 weeks into your 6 week settlement period, it could be kind of carnage by then. Has there been any worry in the industry about that happening?
Yes, there has. Thankfully, most mortgage brokers can order valuations upfront, so before they actually submit the loan application. And so then by doing that, you can protect the borrower if they find a property and then the property market was to head south suddenly, they probably wouldn't be affected. But I do see it as a risk for some people, particularly those going to auction.
And look, I mean, I talked about this with some industry insiders kind of 5 weeks ago, and it's the kind of thing that you would never talk about publicly. But I'm happy talking about it publicly now because I don't see it as a risk factor. But just like we had the run on toilet paper, there was potentially a run on cash with the banks as well. But I think because loads of shops weren't taking cash, then that didn't really kind of eventuate. And I'm really glad that this valuation thing hasn't run either, because otherwise the whole banking system would be screwed. Is if people were buying property and then it was devaluing 10% the next day, suddenly everything would go wrong, wouldn't it?
Yeah, absolutely. And the key point is that it doesn't actually need to devalue 10%. Just valuers need to drop their valuations 10%. And we all know how bank valuers think. They're very conservative.
And so when it comes to the bank valuers, technically, do they have to do it on comparable sales that have settled, that have gone through land titles? Or if something is sold, say, 2 days ago, and it's just not even confirmed, could they still use that as a potential way to devalue that property?
Yes, they can use that as a potential way to devalue it. But the other thing as well is that technically they're supposed to use comparable sales, but think of it as they're going to assume the worst. They always see the worst in the market. And they have to do that because they've got to protect themselves legally. They can be sued by the bank. And so if they think the market's heading south, say a property's, comparably at $1 million, they might still value it at 900,000 anyway. But the best thing to do is you can get multiple valuations from different lenders. And there's in a market like this, there tends to be quite a big difference between valuers.
So, also, picking the time to buy is really hard. So, what indicators can property investors look at, do you think?
Traditionally, property investors have looked at the auction clearance rate to see if the market's, really hot or really cold. And that will predict the future of property prices. But right now, the auction clearance rate is complete rubbish because the social distancing rules means that a lot of auctions have been cancelled. The auction clearance rate has gone from something like 70, 80% down to 40% in a few weeks. And so this is a really big problem for a lot of property investors. We have a large home loan website, so homeloanexperts.com.au. And so we can actually track on a daily basis the number of people that are seeking home loans, which is a really good indicator for the property market. And also we can look at traffic on different pages around buying a property. And so on a daily basis, we can see what's happening. What we've seen in the last, say, month or so is that since the lockdowns happened, we've seen a 50% increase in our traffic. So there's actually quite a lot of people looking to buy a property at the moment, which is something I think a lot of people didn't expect. And if you're a property investor, though, you don't have access to our website data, one of the best things for you to look at is Google Trends. And that can show you what people are searching in Google, which shows interest in different topics over time. So this is selling a home in blue versus buying a home in red. And this is the United States in the last 12 months. And what you can see here is that the number of people looking to sell hasn't really changed. It's gone up slightly, a very, very small amount. But the number of people looking to buy a home has gone through the roof. It's actually at record highs. So I wouldn't consider that to be a buyer's market. I'd consider that to be that there's quite strong demand. And if we were to look at Australia, you can see the same trend. We had the Easter long weekend, which that affected things a little bit. But you can see that the number of people looking to buy a property is through the roof, which is quite interesting. And this is what we see in every crisis: is that there's fear driving people's thinking, and I would say in particular with property vendors, there's a lot of fear around them selling a property. So you can see the number of new listings has dropped off. There's a lot of people who want to buy. I think that's because interest rates are so low and they've seen that their job is stable and they go, well, particularly first home buyers. We've had a lot of first home buyers contact us. and say, look, I really want to get into the market now. This is my chance.
Because logically, it makes a lot of sense. Because in February and March, or at the start of March, a lot of prices we found were going 5 or 10% over valuation because there's so many people at auction. So people have been missing out last year. They're missing out the start of this year. It's that one opportunity of that window, and no one knows if the window is going to be a month or 3 months or 6 or 12 months. But sometimes people will go from having to overpay. Now they've got the chance to get in the market, but then they want the bargain and they want 20% off versus 10%. And the danger is they miss that, just like a lot of people missed the election, and overnight it changed again.
Yeah, that's right. We saw quite a few customers get amazing deals in about mid-March, which is when the lockdowns first started. Particularly those that bought through buyer's agents, we saw that they negotiated some very good prices. We haven't seen that in the last couple of weeks. I think as well that it's very hard to predict what's going to happen in the future, but it could be that once these repayment holidays end, that will be a great buying opportunity. I think it really depends on if the banks extend the payment holidays, which I think that they will, because I think that financially, politically, and just logistically, they won't be able to repossess that many houses all at one time. So I think they're going to have to extend it. But if they don't extend it, then I think property prices will dip quite significantly.
Yeah, I actually had that comment literally about 5 minutes ago with a client before saying, is there going to be carnage in 6 months? And I would have thought there's going to be a tapering effect, that they can't literally have them all. And not everyone would have taken that 6 month repayment literally the day of COVID. They might have transitioned over the next couple of months anyway.
Yeah, that's right. And so it's very hard to predict what's going to happen in the future. I think we can safely say that the next month or two is not going to be a buyer's market, but it is a fractured market. And so what that means is that different suburbs are going to behave differently, and different properties within that market are going to behave differently as well. And so it really comes down to seeing a lot of properties, making a lot of offers. There are definitely good deals out there, but you've just got to be savvy.
Now, for some people, maybe they've lost their job, maybe they can't get serviceability. I mean, certainly for you, you know my details well. We spent 6 months trying to get a mortgage, and my stuff's super complicated. And right at the last minute, then the banks kind of put things on hold. But there is stuff that you can do if you're in my position. And maybe you want to tell the viewers what advice you gave to me, and then I'll tell them the result of literally 3 phone calls.
Yeah, so you don't always have to refinance. Sometimes it is the best way to go, but you can actually negotiate with your lender to get a better rate. And I see for property investors, there's two big opportunities. One is negotiating around the rate, which simply you just call them up, and generally you want to talk to them about their biggest rival. So the major banks, you want to say you've got an offer from another major bank, whereas the smaller banks, you want to say another offer from a similar bank. Or a non-conforming lender, say like Liberty, you might say you've got an offer from Pepper. And that generally means that they'll then compete and sharpen their pencil and give you a better deal. The second thing you might want to look at as well is that in the past, there were responsible lending obligations around interest-only periods. And so getting interest-only was quite a challenge, whereas the government has temporarily relaxed those rules. And so property investors can now switch to an interest-only rate as well.
So, based on your advice, I made 3 phone calls yesterday, or 2 phone calls and 1 email, and managed to get 20% reduction in fee on a $7 million loan with one bank, and I think about 12 or 16% with another bank for a few $1 million. And the only one that wouldn't budge, I only had a 600 grand loan with them, and quite often it's in offset anyway, and so quite often the loan balance is zero. So effectively on my loan of about $10 million, I saved, I think, $70,000 or $80,000 per year, effectively every year, which is an incredible saving. And obviously, not everyone's got those kind of size loans, but even if you've got a loan the tenth of the size of that, and you save 5 or 10 grand, that's a hell of a lot of money to save, isn't it?
Yeah, it's massive, particularly when you look at it over 30 years. And if you were to get that extra money that you've saved and use it to pay off your loan, which I know for a property investor is probably not the right approach, but for a homeowner, that's quite a good approach. Then you'll pay off the loan even a few years earlier, and that can save another 100,000 or so in interest.
Now, I know you've got some amazing articles on your website that talk about exactly how to go through that process. So, do you want to talk about your website name and then how they find those particular articles?
Yeah, so we've got if you just Google home loan experts negotiating your interest rate, then you should be able to find an article about how to do that. But there's a whole range of topics on our website. I think we've got over 1,000 pages about mortgages, so you can just use the search function on our website and really look up anything that you're interested in.
Wonderful, and we'll certainly try and get that website on the screen. So, look, thanks, Otto, for telling the viewers and giving them a bit of your opinion on what's happening in the market. Thanks for helping me with reducing what I'm paying the banks, and which will make me more efficient and more able to keep up the repayments in the future. And we'll definitely get you back on the show as things change over the coming months.
No worries, my pleasure.